Today, we're looking at Chinese inflation data because it seems like the country is in deflation. We're going to see what's going on there. And then the Trading Takeout today is going to be why you need to try and avoid getting stuck in a bias. Make sure you like this video and subscribe to the channel if you want the best market news and views right to your YouTube feed every single day to improve your trading edge. That's right. China is in a bit of a pickle over inflation because their numbers came out overnight and it doesn't look pretty at all. Chinese PPI year on year came in at negative 2.5% versus the expected negative 2.6%. And the CPI was the actual big miss, which came in at negative 0.8% versus expected negative 0.5%. So it's showing that the Chinese consumer is in not the best state. You know, they mustn't be buying things. They must have their frugal hats on. And it makes sense because then you also have data like this that came out, if I can find it quickly. So China Auto Industry Body Official says battery vehicle sales were negative 37% in January, month on month, far below market expectations, which is a main source of pressure on auto market growth. Now, this is something that we've been experiencing globally. You know, the electric vehicle market is dampened and it's on the decline. A lot because, the subsidies have rolled off, the tax breaks aren't there as much anymore, and also the infrastructure is simply not there. And of course, a lot of business leases are up, so the suppliers just hit the market. However, I still think it's a fantastic industry and it will come good again, especially when interest rates come back down. It is very much a speculative phenomenon as it is. But for China right now, that is meant to be a main source of export growth. If you think of, BYD as being a massive, massive player in the EV market, they supply the engines for London buses and a lot of other public sector transportation methods as well. So if we're really focused here on where China goes, this could actually be quite good, funnily enough, for Chinese stocks, not maybe in the shorter term, but in the longer term, because what this is going to force maybe the PBOC to do, which is the Chinese central bank, is cut interest rates, which should put a bit of a support into the falling CSI and other Chinese indices. And if I just grab the CSI, actually, we'll be able to see that it has, in fact, had a bounce over the last couple of days. Now, if you will recall, I did mention this, that the national team were in buying, but I don't think it's sustained. I really, really don't. I think we might tick up to here. But with the data that's come out, I think we will see further downside. However, it's likely that we're not too far away from a bottom, considering this inflation data that has come out. If we look at this on a technical perspective, it's taken this low, looks like it's going to trade and close well above. So that is a massive, massive technical level here. And not that we necessarily want to get involved in Chinese stocks, but it's important for the rest of the world because China is a main trading partner of most countries. If China's doing fairly poorly, it kind of shows that lots of other nations aren't actually buying Chinese goods, and so demand is slowing. That then has an influence on, interest rates, what the Fed thinks about the consumer, what the Fed thinks then about inflation. Because if the consumer isn't buying, then inflation is likely to be dampened. That means that interest rates are likely to have to revert to the downside. That changes everything for bonds, FX, and also risk sentiment. But you tend to have an economic shock before low interest rates mean that there is a support put into risk assets. So that is always what we're looking for. We're looking for what is the maximum extent of a drop in the case of, recessionary fears, and at what level can we be buying risk assets again? That should be always at the forefront, because at the end of the day, indices are sort of designed to go up, especially US indices. The weighted indices are always designed to go up, funny enough. You might not think that from looking at the FTSE and other European indices, but they actually are, especially in the US, when most of the world index is even made up of US stocks. So it tends to be why holding most portfolios in, say, 80-90% S&P 500 is a more prudent way to go about things, and then have a little bit of play money. But in terms of a trading perspective, we want to be looking for perhaps moves now in yen versus the dollar, and you can see that the dollar is rallying at the moment based off of that Chinese number. Makes perfect sense for it to be doing that. We're looking at the potential here for US rates basically to stay elevated versus Asian rates, especially yen, especially Japanese, sorry. And so that is probably where we're seeing this bid in the dollar from over the last couple of days. But, right now, I don't think there's anything necessarily actionable off of anything going on in China. I think everything is very much risk associated. It's very much US rates associated as well. And so for now, there's no conviction from me on which way anything's going. Today's trading takeout is why you should try and never get stuck in a bias. So whenever Chinese data comes out and it's seen as, too good, everyone's like, oh no, that's false. They're making the numbers up. And to an extent, I think they do make the numbers up. However, whenever bad data comes out, like the inflation data today, most people go, oh, yeah, that's fantastic. That's more like it. But it's like, why are you chopping and changing the conditions of, data being good or valid versus when data's bad, just because it suits your own perspective on what things should look like? At the end of the day, if you start getting stuck in a bias, you then start confirming your own biases, and that's not necessarily reality. Reality has to be more objective. You have to be looking at data, and especially in a trading context, you have to be looking at data from the perspective of, okay, how will other market participants take this? Will they take it at face value, or will they be sort of conspiratorial like myself? So that is today's lesson. Really, really try and avoid getting stuck in a bias and look at things objectively. Take a breath and think when you see pieces of information.